In this video, I'm going to give a very high level introduction to what is the Basel Accord. Okay, Basel Accord, as most of you would know, that are a set of recommendations for regulations in the banking industry. Most of us have heard about the Basel Accord, and we know that it's related to the banking industry. But what are the different accords in Basel? And we'll also learn a bit about the capital requirement and the regulatory requirement set out by the Basel Committee. The Basel Committee consists of central bankers who often meet at a place known as the Basel. Okay, so this is the name of a place in Switzerland, where central bankers meet, and they have come up with set of rules and regulations for the banking industry. Okay. um, Now initially there were only 10 countries, central bankers from 10 countries, but now it has expanded to almost all G20 countries, and even beyond that. So far, there have been three versions of the Basel Accord, known as Basel I, Basel II, and Basel III, and we learn a bit about all these three Basel Accords. In the Basel I, which is the first Basel Accord, which it was meant for only capital requirement for the banks. So normally what happens is that many times, because of defaults, because of customers defaulting on the loan, the banks face a huge loss of money, and there is a problem of capital actually. So if there is no money, bank actually go bankrupt and become insolvent, right? Insolvent, that means the bank cannot exist anymore. The bank has to be rescued by the government or by other organizations. So the Basel One was the emphasis was more on capital requirement. That means what is the capital that a bank should always hold in order to avoid the lending risk. That means if people default on the loans, or there are a lot of bad loans, then the bank should be able to be solvent, can avoid the insolvency. That's what is the main emphasis in the Basel One. So what the regulations was that in the Basel I, banks had to set aside at least 8% of the capital against the nominal size of the loan. Okay, so what is nominal size? And technically it's known as the risk weighted asset, or RWA. So 8% of the RWA, or the risk weighted asset, has to be kept or set aside, or has to be there with the bank, for it to be insolvent, or for it to remain solvent. So that's a requirement set out for the banks. Now, how do we calculate this risk weighted asset is something that we'll see now. So assets of the banks were classified into different categories. Now all categories of different assets do not carry the same risk. For example, a government bond, which is one asset, um, do not carry the same risk that an equity would carry. Or taking a more simpler example, if a bank provides loan to the government, the risk is much less than if it provides to the private parties, right? um, so the assets of the bank have been classified into different categories, and different risk weights have been assigned, or were decided based on certain criteria. Okay. So what are these risk weights? Okay. So cash, home country bond, anything of that kind which is completely secure, because a country will most likely not default on the loan. um, and then the cash that you hold, cash is supposed to be a very liquid asset. then there is absolutely no risk related to that. So it's a 0%. So the weight assigned to this kind of assets is 0%. Then securities with good rating, with very good rating. Rating comes from the rating agencies like Moody, S&P, is 20%. And then municipal bond residential mortgages, which is slightly more riskier, carries a weight of 50%. And then bonds with no rating, okay, so nobody has rated this bond, it's a highly risky bond. Okay, so anyway, the banks carries or holds bonds like this, then there is 100% weight on that. Okay, so the risk weighted, that means risk weighted asset is nothing but how much percentage, or the percentage of the asset under risk. Okay, so if it carries asset of cash, then it doesn't, so none of that comes under risk, or none of that is actually risky. Okay, but if there is a municipal bond, let's say a bank carries 100 million of municipal bond, then 50 million of that is very risky. Okay, so 50 million is the RWA. Okay, because it is 50% of that, 50% is risky. So RWA, or risk weighted asset, is 50 million, and the bank has to set aside 8% of the RWA. So 8% of RWA means 8% of 50 million, which is 4 million, right? So if a particular bank holds a residential mortgage or municipal bond of 100 million, then it has to set aside 4 million of cash to be able to meet the regulatory criteria. But one of the weakness of Basel I was it did not take into account the quality of the counterparty. Okay, so it took into consideration the quality of the asset. It classified assets into different categories, but it did not really put much emphasis on the quality of the counterparty. The counterparty could be a very big organization, very good organization, like General Electric, or Apple Computers, or Microsoft. Okay, and the counterparty could be a very small organization, a very small company, which is it's not a big one, or doesn't have a good cash flows. Let's say a small company, small tea selling company, or a small restaurant. Okay, which has taken money from the bank. Now a big company like Microsoft, when compared to a small restaurant in a city, the quality or the creditworthiness of this counterparties will differ a lot. So there is no such classification, or there is no strict rules for the classifying the counterparties into different categories. So no, there is no segmentation rule. Although banks do segment these customers or counterparties into different groups, but there is no rule set out in Basel I, and that was the main weakness of the Basel I Accord. Basel II Accord made it mandatory for the banks to set aside sufficient capital. Again, the emphasis was capital, so capital to mitigate the loss. Okay, so it carried the same thing from the Basel I, to be able to withstand any losses resulting from the credit risk, market risk, and operational risk. So we're talking about three things: credit risk, market risk, and operational risk perspective. In the Basel I, all we had to worry was only credit risk. That means the loss arising from the defaulting of the customer. If customers default, what is the loss that is incurred by the bank, and does the bank have enough cash or enough liquidity to be able to withstand this loss? Now in the Basel II, that the three types of risk which are involved: one is credit risk, the other one is market risk, and operational risk. We have talked about market risk and operational risk in one of our video in this section, so you can go through the details what market risk is and what operational risk is. To talk about it in brief, market risk results from movement of market, because movement of market, or the risk that arises because bank holds a lot of position in different capital market, and because of that, risk is involved, and the bank can incur a lot of loss. Operational risk is because of incidents, like bad incidents, like fraud, uh, or any kind of risk related to a catastrophe, like natural catastrophe, or the government, the issue with the government, local government or foreign government where the bank is operating, and so on, or terrorist attack, and so on. So that comes in the under the operational risk. So loss happening because of any of these three components, or any of these three risk types, like credit risk, market risk, and operational risk, will have to be taken into consideration while calculating the capital requirement, unlike Basel I, where there was only credit risk. It also put emphasis on risk management practices followed in bank, which was not the case in prior to that. So regulators now can intervene into how the management structure is, or how the management structure has been put into action within the bank, and how the bank really measure the risk or quantify the risk. So that was taken into that was given a lot of emphasis. So the internal capital adequacy for risk, assessing risk internally. So ICAP in short, reports have been uh, there was strict criteria on that. And secondly, the external reports. So external reports were regulatory reports, which would measure the risk and quantify the risk, and also talk about how this risk will be handled by the bank. So entire details has to be reported to the central banks. The weighting factors in the Basel II remained same, and it also changed quite a bit in terms of the percentage. Well, the methodology remained same. There was segmentation across different types of asset classes. Government bond carries the least risk. Banks and corporates carries higher risk, and also it depends on the rating. Okay, good rating assets has got less weighting, risk weighting in the while calculating the RWA. Okay, whereas more risky assets, or assets with lower rating, has got higher weight while computing the risk weighted asset. However, Basel I and Basel II, same or different. Basel I did not differentiate creditworthiness of the counterparties. Okay, so that's one weakness that we have already talked about while determining the risk capital. Whereas Basel II made the distinction between creditworthiness of customers, and it also took care of the operational risk, which was missing in the Basel I. The 8% capital requirement that we talked about in the Basel I remains same, which is also known as the BIS ratio. Okay, the recent one is the Basel III. Okay, the Basel III is more recent phenomenon. I think it came in 2010. You can check the date. I'm not sure if 2010 is correct, and I think it's still under process. Banks have been implementing. Not all banks have already implemented. I think there's some strict criteria. It has to be implemented by 2016 or 2017. Just check the dates. I'm not sure what the dates are. It introduces the leverage ratio, okay, and the liquidity requirement. So it's not just the loss that matters to the matter to the regulators. It's also that what is the scenario, capital scenario, or liquidity scenario with the bank. Okay, And remember that Basel III come followed by after the financial crisis happened in 2008, where there was credit crisis. Okay, so it's not just because of not just customers defaulted on the loans. It's also that bank ran out of cash, and bank had severe issues with the liquidity. They didn't have enough liquidity for operational purpose, for you know daily operation. And it also categorized capital, and it hold it gave emphasis on three types of capital. First one is the common equity tier, known as CET1. And the second one is additional tier, known as AT1, and then third one is the tier 2 capital. So there are three classification of capitals. Okay, so what is CET1? Under CET1, what comes are the common shares issued by the banks, um, and the earning of the bank. Okay, so that comes on the CET1, which is the main asset of the bank, right? That's the most important asset of the bank or any bank. Then additional tier, okay, or AT1. Um, so any asset which meets these criteria, like the term must be perpetual, okay, there should not be any fixed term, and the issuing bank, that means if the a particular bank is holding asset from a different bank, the issuing bank should not have no incentive to redeem the position. Okay, and then the tier 2 capital, any asset which comes under this should have some criteria, like minimum term should be 5 years, and then issuing bank should not have incentive to redeem. Not just these two criteria, in fact there are many of them. I have not listed out all these criteria. So the idea is that the capital or the liquidity requirement has been classified into different types, so that there will be a clarity about what is the kind of capital that is that is held in the bank. Not just the amount alone, but that has to be a classification of that. So liquidity requirement has been the main emphasis or main importance given in Basel III. It's not yet in the final form, so it's evolving over time. So that will be more clear over time how Basel III is implemented, and what are the pros and cons of Basel III, and how banks are reacting to the Basel III regulations. Okay, so the emphasis in Basel III is higher required level of capital. Okay, so that is somewhat raised from the 8% in the Basel I and Basel II. And also the banks have to have the capital buffer, that in the good times bank make money, right? So the regulators now put an emphasis on that, when there is a good time, when uh, you can actually make money out of it, you have to have the capital buffer which will cover up for your cost of capital, or borrowing cost in a bad time situation. Okay, so the capital buffer is a new term introduced in the Basel III, which ensure or which put a condition to the bank that you have to save money, or you have to have that buffer money to really withstand the bad economic scenario or a bad environment. So thank you so much, and please subscribe to our channel.